I will delete this file in 20 minutes, not because it's classified, because after today it stops being hypothetical. If you own silver, trade it, insure it, or depend on anything that needs it to function, you are already downstream from a decision made far away from screens and statements. At 4:02 a.m. London time, the shipping map went gray. Not red, not flashing, just gray. Lanes that had carried metal for decades simply stopped updating, as if someone had lifted a finger and muted a nerve. In the operations room, the air changed before the numbers did. You could feel it. Phones stopped ringing. A keyboard clacked too loudly and someone looked up, irritated, like noise had become inappropriate. On one wall, a dashboard labeled Maritime Risk Overlay flickered between statuses, then settled on a word that never appears in press releases. Unavailable, not delayed, not rerouted, unavailable. The Red Sea is not a place on a map when you work risk. It's a compression point, a throat, 30 miles wide in places, carrying a disproportionate amount of the world's industrial blood. And silver moves through it the way oxygen moves through lungs. Concentrates from East Africa. Doré from Central Asia transiting to refiners. Industrial bars headed to electronics hubs. Jewelry stock bound for seasonal demand. All of it assumes passage. All of it assumes someone else will take the risk. That assumption broke quietly. The first memo didn't mention silver. It never does. It mentioned insurance. War risk premiums were suspended pending review. That's the tell. When underwriters stop quoting, movement stops. No captain sails uninsured. No bank finances uninsured cargo. And when insurers pull back, shipping companies don't reroute heroically. They freeze. At 6:15 a.m., an internal brief circulated with the bland title, Logistics Disruption Assessment, version 2.1. Page 3 had a table nobody wanted to read. Commodity exposure by route, crude oil, LNG, fertilizers, then industrial metals, copper, aluminum, and silver, highlighted, a red cell with a footnote, 40%, not demand, supply. 40% of globally deliverable silver flows had become conditional overnight, not destroyed, not sanctioned, just trapped behind a corridor that no longer existed in practice. The spreadsheet didn't panic. It didn't speculate. It simply recalculated availability under new constraints. Refiners in Asia flagged feedstock risk. Fabricators adjusted production forecasts. A bullion bank quietly widened bid-ask spreads without explanation. The screen still looked calm. Spot price barely moved. That's how you know the problem isn't priced yet. Here's what most people miss. Silver is not like gold. Gold sits. It waits. Silver works. It's embedded in circuits, solar panels, medical equipment, chemical catalysts. It's consumed. When supply tightens, inventories matter, and inventories are thinner than anyone admits, because carrying silver is expensive and nobody wanted to tie up capital when paper claims were cheap. For years, the system optimized for efficiency, just-in-time shipping, minimal stockpiles, financialization that treated metal as a line item, not a physical constraint. Futures contracts multiplied claims on ounces that moved only if nothing went wrong, and nothing was supposed to go wrong. Until a shipping lane became a choke point. The first real signal wasn't price, it was behavior. A refiner in Gujarat requested accelerated delivery on a contract that hadn't been urgent before. A fabricator in Shenzhen asked about alternative grades, something you only do when primary supply is uncertain. A logistics firm rerouted containers around the Cape of Good Hope and quietly added 21 days to transit. Time is cost. Cost becomes margin. Margin becomes availability. By midday, leasing rates ticked higher, not dramatically. Just enough to notice if you knew where to look. That's the physical market whispering to the paper market. That's metal saying it wants to be paid to leave storage. Someone needed bars. Now. At 11:40 a.m., a call came in from a desk that never calls unless something structural is shifting. They asked a simple question. How much unencumbered inventory is actually movable within 30 days? Not reported, not allocated, movable. The answer took too long. When it came, it was lower than expected, much lower. This is where the logic of the system reveals itself. When supply chains break, prices don't immediately reflect scarcity. They reflect liquidity, and liquidity is still abundant in paper. Futures trade, ETFs rebalance, options roll. It all looks functional, but delivery is a different universe. Delivery requires ships, insurance, timing, trust. And trust had just been re-rated to 0 for an entire corridor. The feedback loop starts slowly. Manufacturers hedge future needs, pushing demand forward. Traders front-run expected tightness, pulling metal out of circulation. Inventory managers stop lending. Leasing rates rise further. Each step removes metal from availability. Each removal tightens the squeeze. But the price chart still looks polite. Then comes the margin math. Industrial buyers don't care about charts. They care about inputs. When they can't secure silver at predictable prices, they do two things. They hoard what they have, and they pay whatever clears. That creates localized premiums, regional dislocations. Futures stop converging with spot. Arbitrage fails because you can't move metal through a lane that's shut. At that point, paper claims become dangerous, because if enough holders decide they want delivery, not rollover, the system has to answer a question it has avoided for years. Where is the metal? I've seen the inventory reports. Category lines that look healthy until you read the footnotes. Eligible, registered, pledged, rehypothecated. Metal counted more than once because it can be, because it usually doesn't matter, until it does. By late afternoon, a clearing member requested guidance on force majeure clauses related to physical delivery. That's when the room went quiet again. Force majeure is the last stop before defaults get renamed. Nobody wants to say the word. They say disruption, constraint, temporary imbalance. Words that buy time. But time is the one thing a supply shock doesn't give you. The Red Sea blockade didn't just slow ships, it rewired risk models. Routes around Africa increase fuel costs, transit times, and exposure. Insurance premiums don't just return, they reset higher, permanently. Some flows don't come back at all. They seek alternatives that don't exist at scale. And silver doesn't wait politely while you redraw maps. This is the anatomy of the cut, not a headline. A series of small, rational decisions that compound into a structural shortage, each actor behaving sensibly within their mandate. Insurers protecting capital, shippers avoiding risk, banks tightening terms, buyers pulling forward demand, sellers withholding supply. No villain, no panic, just math. And math doesn't negotiate. By the end of the day, the dashboard still looked calm. Prices still behaved. Commentators talked about geopolitical noise. Analysts wrote notes about limited impact. But in the physical market, something irreversible had happened. A 40% supply pathway had been removed from the equation, and nothing of equal capacity was ready to replace it. This is where the system always fails. It assumes substitution where there is none. It assumes time where there is urgency. It assumes that because price hasn't moved, risk hasn't arrived. Silver is about to teach that lesson again. Because when industrial metals go scarce, the first phase is denial, the second is scramble, and the third is a repricing so violent it looks irrational, even though it is the most rational thing that can happen. We haven't reached that part yet. But the lane is still shut. The ships are still waiting. The metal is still on the wrong side of a corridor that no longer functions. And the supply chain does not care how calm you feel when you look at a chart. And here, the road splits into 3 paths, and every one of them leads into a narrowing corridor where time itself becomes the enemy. From a distance, they look different. From inside the system, they feel the same. Pressure without sound, motion without relief. On the first path, the one they will later call stabilization, the blockade never fully resolves, but it fades from attention. Convoys resume intermittently. Insurance returns with exclusions written in language so dense it might as well be a warning label. Shipping schedules stretch, but they stretch predictably. The market exhales. Commentators say the disruption was absorbed. Prices grind higher, politely, as if acknowledging inconvenience rather than scarcity. But watch what actually happens beneath that calm. Refiners carry less buffer. Fabricators redesign processes to use thinner margins of metal. Governments quietly classify silver as a strategic input without using the word strategic. The system adapts by becoming fragile. It survives by reducing slack. And when slack disappears, resilience goes with it. This path looks like success because nothing breaks loudly. It is a long, thin survival that depends on nothing else going wrong. History suggests that dependency never holds. Then the curve bends and you find yourself on the second path, the one that feels manageable until it isn't. The lane remains unreliable. Incidents cluster. Insurers don't pull coverage entirely. They reprice it weekly. Shippers reroute more often. Transit times become variable. Deliveries miss windows. Missed windows miss production cycles. Production cycles miss contracts. And penalties begin to appear where none existed before. In this world, the physical market starts to assert itself. Regional premiums widen. Fabricators in Asia pay more than those in Europe. Arbitrage becomes theoretical because moving metal costs more than the spread. Futures continue to trade, but delivery terms get renegotiated quietly. Cash settlement clauses appear in footnotes. Leasing rates jump again, not because of speculation, but because holders realize lending metal now means not having it later. This is when inventories start telling the truth, not the reported numbers, the usable ones, bars that are actually free to move, ounces not pledged, not promised, not already spoken for in some other contract. That pool is smaller than anyone advertised, and once participants discover that, behavior changes fast. Industrial buyers stop optimizing and start securing. They pull demand forward by months. They overpay to guarantee supply. Traders respond by withholding. Withholding tightens availability. Tightness validates higher prices. Prices invite more paper interest. Paper interest increases the gap between claims and metal. The loop closes again. And then there is the third path, the one nobody models honestly because it involves admitting physical limits. This is the path where the blockade doesn't need to be total to be decisive. A few more incidents, a few more insurance withdrawals, a few more reroutes that fail to arrive on time, and suddenly the assumption of continuity collapses. This is where delivery breaks, not dramatically, procedurally. A contract rolls instead of settling. Then another. Then a major participant announces revised delivery options to ensure market integrity, which is language for we do not have the metal where and when you expect it. Futures detach from reality. Spot trades thin out. Prices gap in places nobody watches because those places don't publish charts. Industrial users begin rationing internally. Solar manufacturers delay installations. Electronics firms redesign boards. Medical suppliers prioritize certain products over others. None of this makes headlines. It doesn't need to. The impact shows up in margins, then in layoffs, then in output. Scarcity doesn't announce itself. It propagates. Now listen carefully. Do not watch spot prices alone. They are the last thing to move. Watch the lease curve. When short-term lease rates spike above long-term ones, metal is being pulled out of circulation now. Watch exchange inventories, but read the footnotes. When categories shift from registered to eligible, that metal is not available. Watch delivery notices versus open interest. When the ratio collapses, the paper market is crowded beyond what the physical market can support. Watch freight rates on routes no one talks about. When they rise faster than headline lanes, rerouting is failing. Watch insurance bulletins. When exclusions expand geographically, risk is spreading. Watch behavior at the top. When sovereign mints slow retail programs while claiming ample reserves, priorities have changed. When central banks stop lending metal quietly, they are preparing for absence, not volatility. So what do you do when you understand that supply is not delayed, but diminished? You stop treating silver as a trade and start treating it as infrastructure. Infrastructure is not optimized for turnover. It is secured for continuity. You don't chase price. You secure access. You avoid instruments that promise exposure without delivery. Exposure is easy. Possession is hard. That difference matters when lanes close. You diversify how and where you hold value. Not because collapse is guaranteed, but because concentration fails under stress. Cash is not safety, but liquidity buys time. Time buys choice. You do not need to abandon the system. You need to avoid being trapped by a single assumption it makes. You remove some counterparty risk entirely. Physical metal is not a bet on chaos. It is a hedge against logistics, against insurance, against geopolitics that reprice risk overnight. Gold plays this role broadly. Silver plays it specifically, tied to function rather than belief. You hold it not for yield, not for momentum, but because it exists without permission. You shorten promises. Long supply chains are promises layered on trust. When trust thins, chains snap. Favor arrangements that can be verified quickly. That settle physically. That do not require a corridor to remain calm for weeks at a time. And then comes the philosophical line most people avoid because it demands responsibility. You stop equating normal with safe. The most dangerous phase of every shortage is the one where everyone agrees it is manageable. That consensus is what empties inventories. That confidence is what keeps paper claims expanding while metal disappears. By the time price reflects reality, the choices are gone. This is not about fear. Fear is reactive. This is about alignment. Aligning what you depend on with what can actually be delivered under stress. Aligning expectations with physics, not narratives. The final comfort they offer you is that markets always adapt. They do. But adaptation has winners and losers. Adaptation reallocates power, and it rarely favors those who trusted the longest. Silver does not care about statements. It does not care about optimism. It moves through routes, through refineries, through hands. When a route closes and stays closed long enough, the system must answer a simple question. Who gets what remains? That question is being asked now, quietly, in rooms without windows and documents without adjectives. The answer will not be fair, it will be functional. And when that answer becomes visible, when prices finally move in a way that looks irrational to those watching charts, remember this moment. The moment when the lane went gray. When unavailable replaced delayed. When 40% of supply stopped being theoretical. You still have a choice before that repricing completes. Not to predict outcomes, not to call dates, but to position yourself so that when the system adjusts, you are not surprised by rules that were written long ago and activated without warning. That is the last form of leverage left. The right to say no, and to mean it before the ships start moving again and everyone pretends nothing changed.